Hello, everyone, and welcome to a brand new episode of OIC's Wide World of Options. I'm your host, Mark Benzaquen. I really been looking forward to this episode for a long time, and the reason being it's a topic that I often discuss when I'm on the road talking to investors or even in our OIC webinar program. And that topic is the difference between market makers and retail investors. The idea is, market makers play a different game than the retail investor does. They have different set of rules. So to help us understand what those differences are, what that set of rules might look like, I'm very excited to welcome an old friend of mine, an old colleague from the trading floor, Wes Breton of Breton Holdings LLC. Wes, thank you so much for joining us. Welcome to the show. And I got to tell you, it's fantastic to see you again, my friend.
Yeah, thanks for having me. It's a pleasure to be here and excited to, have the conversation.
Yeah, this will be fun. So Wes, for a very long time, Andrew Trading was the group that you were a partner with over a decade. You've got a lot of market making experience. From that transition, you are now trading for yourself. So you are seeing both sides of the coins, the market maker versus the retail investor. Let me ask you, let's start with this. And this is an idea that I don't necessarily fully agree with, but I want to get to it. I often hear from investors that the options industry, it's kind of like a casino, that market makers are the house and the retail investor, those are the people sitting at the tables. I don't necessarily agree with that assessment for a number of reasons, but I want to hear your take. Do you agree that the market makers are the house, so to speak? And do they have a distinct advantage over the retail investor?
Advantage, I don't know. I think there's a lot of similarities. I like that analogy actually.
Yeah.
Uh, I would put it in the terms of price makers and price takers. So
Okay.
your market makers are your price makers, right? Especially in the options business. If you want to buy or sell, some particular put, call, complex strategy or whatever, a market maker needs to make that price for you. And they are agnostic to a certain degree about, where they think the market's going to go. And they have a structure where they believe this option, this structure, this spread is worth X, and they'll make you a two-sided market. This is a price I'll buy it. This is a price I'll sell it. And all they're
Hmm.
really trying to do is capture that theoretical edge. Where your retail investor is your price taker, right? He's, either hedging or making a directional bet, and he's going to take the prices from the market maker. So there is some similarities to the casino because I think the market maker has some advantages that the house has on a casino is the fact that they're the one making the prices. They're the one
Hmm.
setting the odds. Uh,
Yeah.
so there is some similarities.
Right. And it's something that, that I talk about when we were on the trading floor. You were a market maker. What was your monthly nut just from your seat lease? In the tens of thousands, right?
Yeah, I mean it fluctuated based on what the value of the seat was at the CBOE, but yeah, I mean I think I got as high as like 15 to $18,000 at one point, but that was just a fraction of what your overhead was because you had
Right.
massive technology spend, you had support personnel, your own insurance, all that sort of stuff. I mean, it
Payment
was
for order flow. Right.
at the end, that was our largest expense was but they payment for order flow, which they called the CBOE marketing fee. But we were paying tens of thousands of dollars every month in payment for order flow.
Yeah,
Um,
and that's a separate topic that boy I
right.
could I could talk for hours on. But let's get back to your point. You were saying that as a market maker, you were kind of agnostic, and that's something that I tell the retail investor in the sense of the market maker doesn't care if you're buying or selling. They don't care if you're trading a call or a put. They don't care if you're doing an iron condor or a covered call. They don't care as the retail investor. They don't care what you're trading. All that they care about is the price, and really not even the price, but the implied volatility level that as the market maker that they're able to get, right? So, and that kind of goes into there's a phrase that one of my colleagues likes to say when it comes to market making: calls or puts, puts or calls, et cetera. The idea is, as you had mentioned, they're agnostic. All they want is that edge. Can you expound on that a little bit? What does that
I
mean
think
to
that's
the listener?
that's true for the most part. Is that they have an obligation. Right now it's mostly traded electronically, and you have an obligation to post quotes, um, and you will trade anything. That being said, there are trades you would prefer to make over others.
Yeah.
Um, so you are agnostic to a certain degree, but there are trades as a market maker where you get hit on something and you're like, I hate this. Immediately,
Right.
you're going to lose
Right.
money. So like, there are trades you like to make and trades you don't like to make. That's kind of the art of it. Um, yeah, so you are agnostic. And when those trades that you don't like to make, like say you're selling an option that you're already short a bunch of and you don't want to
Yeah.
sell it more,
Right.
but there's always a price that you will make that trade at. Maybe I won't sell any at the same level or the same volatility level that I've been selling, but I'll sell some at a higher volatility level because now I've increased, the chances that I'm going to make money because the price, I'm going to collect more premium for this option that I don't want to sell.
Yeah, and
Makes
that
sense.
makes sense. But I want our audience to know that there are rules that the exchange imposes upon market makers. So you cannot just make the market as wide as you want. Three bid at a quarter, fine. Three bid at $15, not so fine. That's something that the exchange wouldn't allow. So they have rules that the market makers have to follow in terms of the width of the markets that they quote, the size that they're quoting for. As a market maker, do you have to provide a quote on every single strike and every single maturity?
I believe it worked on a percentage. Like you had to quote, 60% of the listed options 80% of the time, or there was some sort of
Okay,
formula, and they would
gotcha.
give you relief in really volatile times. They would call it a fast market, and you give relief where the
Right,
quotes would
double
either widen
wide and
out or you
triple
wouldn't have to
wide. Yeah.
quote as much, or you had to be in there a certain amount of time of the day. You did have obligations in order to, be a market maker. And there's a benefit of being a market maker is you get to make the prices. You get pretty favorable margin requirements. You don't have
Mhm.
to post all the required capital to buy or sell options. Like you're getting, you only
Right.
put a portion of what you need. In order to get all that favorable treatment, you had obligations.
Yeah, and in exchange for that advantage, obviously you were paying that seat lease. So for that seat lease, there had to be a reason that you were willing to pay that that high fee every month. So I do agree that the market maker does have some advantage. I love your point about, well, yeah, they're the ones that set those prices. Let's get into that. How do they set those prices? I know that when you're working for a trading firm, you're using an algorithm of some type, whether it's off of Black-Scholes or some other pricing model. Does that differ, or did that differ from when you were a market maker to when you're now trading on your own? Do you come up with your own pricing models, or how does that work?
Well, back when I was a market maker, yeah, you had, some version of a Black-Scholes model. Like we used an off-the-shelf, software platform that, we rented that had it was able to price, option SKUs and so
Hmm.
forth. Other bigger firms had their own proprietary uh, stuff. And then, a lot of people would get lazy and just would they use a button that they call fit to market, right? So you might get some of the bigger firms like your Chicago Trading, your Wolverine, your Susquehanna that would drive prices, and then people like me that were a little bit more independent, I could just fit to market, and then my theoreticals would fit into the middle of the bid ask, and that would
Hmm.
produce a skew for you in theoretical prices, and you could work off that. And to a certain degree, everyone's always doing that because you're always trying to fit prices to where other people are quoting it, right? Because it's a market. So it's a combination of everyone's quotes is what the
Right.
market is. Yeah.
Right. And you don't necessarily want to stand out because, maybe you're standing out for the wrong reasons. If everyone's
Well,
willing to pay a
exactly.
dollar, you don't want to say, yeah, I'll pay a buck and a half.
Well, yeah, you want to trade with, what we used to call customer paper, right? Someone would, come and want to, buy 500 puts or 500 calls, whether it was retail or institutional, whatever. Those are the people you wanted to trade with. I didn't want to trade with, Susquehanna or Wolverine or, people that might have been more sophisticated than me, because then you were always under the feeling that you were probably getting picked off. So like the professional didn't really trade a ton. There were times when we would trade with each other, but we more wanted to interact with, customer order flow.
Right, that customer paper. So you and I had during our pre-call, we had talked about how when you were a market maker, you wanted to trade as often as you can, right? You wanted to be on every single possible ticket. You wanted to trade size. Now that you're trading your own money, that has changed. Can you tell me how that has changed?
For sure. It goes back to the price maker versus price taker philosophy. As a price maker, you're getting paid on the front end of the trade, right? If I have an option that I think is worth $5 and I can sell it for 5.20, or I can buy it for $4.80, I'm capturing 20 cents of what we call theoretical edge. You can't the theoretical checkbook doesn't always write checks, but you're trying to accumulate as much theoretical edge as you can. And the more you trade, the more edge piles up, the more P&L you're likely to have.
Yeah.
So, on the price taker side, now you're the one paying $5.20 for that $5 option. You're actually incurring a 20-cent loss, on the front end of the trade. So then you're hoping to get the movement, which makes that option worth more. Now, to be fair, spreads have tightened up a ton over the last like 15 years since when you and I were in the pit. So, customers now actually give up not a ton of edge on the front end. There's a
Hmm.
ton of like penny wide, options. Some of the stuff trades
Right.
fractions of penny wide. So they don't give up as much as they want, but as they used to. But yeah, it's just a different mentality of getting paid on the front end of the trade or, trying to get paid on the back end of the trade.
Right. So as again, the way that I explain it, as the market maker, you're collecting that theoretical edge. You don't care if they're buying or selling calls or puts. You just want the difference of what they're buying or selling versus what you have it worth. As an investor, retail, you've got a forecast. You want the market to go up. You want it to go down. You've got an objective, whether it's buying a protected put to hedge your position, a covered call to squeeze out some income. You've got a reason to do that trade, and you want that objective to be met in order to profit. Now that leads into my next question, which is hedging. The difference between a retail investor and a market maker to me is a market maker, you buy a call and you're immediately selling stock against it, or you're selling a call against it, or you're doing something to offset your risk. As the retail investor, and it's a question that we get often asked a lot is, do I trade delta neutral? Should I do, gamma scalping, for example, which I know isn't, exactly hedging, but, the idea is that the hedging your portfolio as a market maker is vastly different from a retail. Tell me about as a market maker, did you hedge every single trade and how did you do it?
Yeah, I mean, you're trying to mitigate risk at all times, right? So going back to what we said, you're trying to capture that theoretical edge. Now, as a market maker, what happens is you build inventory. So, since you're trading across different series, different months, puts, calls, spreads, what you end up is you build this large inventory of shorts and longs and different strikes. And that is the hard part to manage because now you're taking on risk. So you're always trying to mitigate risk as much as possible. Your first risk is your delta risk, right? So if you're selling a call, you're short. So now you have to buy futures or buy stock, right? But well, it goes further than that. You're not just short delta, now you're short volatility, right? So if I sell an option, I'm looking to buy another option. That way, if volatility moves up or down, I have an offsetting, option to offset the risk of the trade I just made. So, where it gets difficult is you've got a lot on, and you don't get a choice in what you trade, right? You're taking the other side of the order flow as it comes into the product. So a lot of times you will have lopsided inventory. You might be long a group of strikes over here, shorter group of strikes over here, and trying to manage that inventory is really the difficult part about being a market maker. Like we used to say, it's easy to make money, but it's hard to keep it because you would pile on this
Yeah,
risk for theoretical edge, and then all the guys in the crowd would have on the same position, because we're all trading the same stuff.
right.
And somebody would, move their prices violently to try and get out of it, and then we'd all get smoked, as the prices moved against you. So it was always interesting to see like how you could manage risk, who are the people that were going to, puke out of it first, which was always
Yeah.
typically the smartest thing. You really wanted to get out first or get out last. If you got caught in the middle, you just got trucked, you know. Um, yeah, so it's different, as far as the customer side, the retail side, it all depends what they're trying to accomplish. If they're trying to make a long volatility bet and they're buying a straddle or buying a strangle, yeah, then you probably want to scalp some gamma, right? That's the whole point
Yeah.
of being long volatility. But if you're just buying a call hoping to get a big upside move, hedging that every time you get an upside move, you're probably not going to work out in the end, right? You're just going to chop
Right.
yourself up along the way. So, it's just different. It's just a different side of the market.
Yeah. I like your point about being in the trading pit, everyone's kind of got the same position on because the same paper is coming into the same people. So how do you get out of your position when everybody's trying to do the same thing?
Well, this is when it would get tough, is that market makers would then try to trade against other market makers, right? Sometimes they would, go through a broker to try to get out of something. So, the market makers thought they were trading with customer paper, but it was actually
Right.
a market maker going through a broker. Um, sometimes you worked your butt off to get out of it. Sometimes you just
Yeah.
worked, like it was,
Yeah. And
yeah,
it's funny because, as on the brokerage side, some of my biggest customers, of lack of a better word, were actual market makers.
for sure. Yeah.
Yeah. So yeah, that's interesting. I didn't think about that. Yeah, good point.
Yeah.
Well, this has been fun. This has been a terrific talk. I really like it. It's, again, it's something that we do or something that I get asked about a lot. What's the difference between market makers and retail? Does one have an advantage over the other? Is one the house? Is the other, the gambler? And we certainly don't want to equate um, trading options to gambling. So, please, I don't want to, people to say that that's what we're trying to do. I think the two are very, very different. But as you had mentioned, as the metaphor, it kind of works. So, for our legal team out there, I am not making that distinction, or I am making that distinction. Options trading is not gambling. Now, that being said, let's move on to something else. What's your favorite sandwich?
My favorite sandwich. I've become a bigger fan of the Reuben over the years. I'm a big fan of the
Oh,
Reuben. Yeah,
well done. You like all the garbage on top of it,
I do.
the
Garbage.
Thousand
Yeah.
Island, and yeah, and the
I think it's sloppy and messy and
oh,
yeah,
gross.
highly caloric. Yeah, sign me
Highly
up.
caloric, absolutely. What's the most used app on your phone?
It's got to be Twitter or X. Yeah,
Yeah, you're on that
I'm
a
kind
lot.
of
Are you a
a,
junkie?
I'm a Twitter junkie. Yeah.
Now, do you for again for I don't know even know what they call it now. Do you tweet or on your own, or do you just kind of stalk everybody else?
I try not to tweet as much as I used to because now I just find myself like fighting with anonymous people on the internet, which seems like
Right,
just a waste of brain cells.
correct. Yeah,
But I
rage
love
bait
it
and
for just newsfeed and information. I feel like it is the best news source out there. If you need quick information on anything that's going on in the world, like it's easier to
yeah,
find there than, you know, on the
then
internet
mainstream
for the
media.
news.
Yeah.
For sure. Yeah.
Celebrity crush. Who was your first?
My first, I would say middle school. Who's the boss? Alyssa Milano.
Oh, all right. I
Yeah.
remember her.
Yeah.
Interesting. Alyssa
Sam.
Milano.
Sam from
Yeah,
Who's the
Sam,
Boss?
that's right.
Yeah.
Sam, Sam Maselli, I think
Yeah.
was
I think we
the
were about the same age. Yeah.
something like that. Interesting. I can't imagine, and from what I remember you on the trading floor, I can't imagine that this next question applies to you. But if you are absolutely forced to, what is your go-to karaoke song?
Oh God. I am not a singer. I will tell you, I tried to do years ago at a bar. I'm like, oh, I'll go do Living on a Prayer by Bon Jovi. Oh my God. Don't ever do that in karaoke.
Yeah.
That thing is so fast and so hard to sing. And I just completely bombed and made an ass of myself.
Oh, I love it.
So since then, I will never do karaoke again.
I get it. I get it.
Yeah.
Understand. And that's a very valid reason not to.
Yeah.
Last question. This is a little bit more realistic. We're a little bit more serious. What is something that you think everyone should understand about life, but absolutely just don't?
Oh,
What
um,
should people know about, just being an adult, let's say, and yet they seem to have no clue?
I think that like the only thing that really matters like in life is your relationships, right? I
Hmm.
mean, I think so many people are so, ambitious to the point of I got to do this, I got to do that, and I need all these levels of success. And, they don't take time to spend with their kids, they don't take time to spend with their wife, they don't take time to spend with their family. I think like as you get older, you realize that like all this material stuff is
Yeah.
pretty irrelevant.
Right, completely agree. Yeah, relationships are the most important thing, and that's excellent. I'd love to see that you've gained that wisdom.
Yes.
Since I saw you last.
Yeah.
That's wonderful. Wes, I apologize, Wes. I really appreciate this. This is great. It's fantastic to see you again. So great to catch up, and thanks for spending your time with us. I really appreciate it.
No, I enjoyed it. Thanks for reaching out. I appreciate it. And it's good to see you again, Mark.
Yeah, you too. Thank you. Ladies and gentlemen, that's going to do it for our episode today of Wide World of Options. Again, special thanks to Wes Breton of Breton Holdings, LLC, and to all of our listeners for joining us. If you're interested in our OIC webinar program, go to our website, optionseducation.org. Our webinars are going to be the second and third Wednesday of each month. We also have our all-new OIC Ask Us Almost Anything. That is going to be the second and third Thursday of each month. And all of your options-related questions, direct those to options@theocc.com. Wes, thanks again for joining me. Ladies and gentlemen, thanks for your support. Happy trading, and we'll see you next time. Take care.
See you, Mark.